If I lost everything and had to start from scratch today, I wouldn't chase hype stocks and I wouldn't try to predict the next big thing. I would simply focus on a tried and true process that actually builds wealth. Let me show you what I'm talking about. Most investors are going to ask, what's the one stock you'd buy right now? Well, guys, if I just start over right now at the age of 44, my answer is very simple. I wouldn't buy hype. I would buy the most undervalued stock I could find. I'm going to walk you through exactly how my approach to investing has changed over the years and why I focus on value over everything else. How I find great businesses at great prices and the principles I live by to make sure that I'm not just speculating, but I'm actually investing in real businesses for the long term. I'm even going to share examples of stocks that I own right now, including the ones that I think are selling at the best value relative to price as we speak. Now, while most investors are going to chase hype, I chase value. I'm not judging, guys. There is a way to chase hype and momentum and make money. That's not investing, though. That's trading. And most people don't even trade with the process. They're basically just speculating. And guess what? I've been there. 25 years ago, during the dot-com era, I chased tickers. I chased prices. I chased stories and tips. In 1998, I made 98.6% in 1 year. And I thought, oh, this is easy. I remember somebody telling me that they averaged 18% a year over the previous 15 years. And I thought, why so low? That was the level of what we were experiencing back then. I thought I was a genius until the market started to crash. And a tip that I thought was a for sure thing because the story made so much sense. Global Crossing, it went to zero. Global Crossing, the CEO was on the cover of Forbes magazine as the fastest billionaire ever at that time. In less than 11 months, he became a billionaire. My sister's boyfriend's father at the time told me, Paul, you gotta buy Global Crossing. They're laying fiber all across the world. They're changing the entire access to internet everywhere. And I thought, oh my God, this can't miss. Now, of course, I'm not blaming him. I'm a big boy. I made my own decision. The thing went to zero, and I love joking about it today. But after the market fell and everything crashed, I had my Warren Buffett type moment. Wait, there's something wrong here. All these great ideas did not pan out. The internet changed the world and continued to change the world. Why did all these businesses go to zero? Well, because when I was buying them, I was buying a piece of a business, but in actuality, I was speculating and trying to buy my lottery ticket. And that's not the way to invest. Here's the truth. I avoid hype now because I like getting a return on my money, and hype can destroy that. It works until it doesn't work. Most investors, they get caught in the emotional highs. They get caught in the FOMO, the fear of missing out because their friend, their sister's boyfriend's father made a lot of money on a company. A stock goes up 400% in a year. Has to be a winner. Everyone's talking about it. You can't miss this rocket ship. But they don't realize they're not buying a business. They're buying a story. And stories don't pay over the long term if you don't pay the right price. Cash flow does. The second tenet of our principle-driven investing, every investment is going to be the present value of all the future cash flow it'll receive. That's it. If you can understand that, you can understand investing. That's the whole game. If I lay out $10 today for an investment, my return is going to be based on all the future cash that thing receives. If it receives zero for the rest of the time, I'm going to make a 0% return. It's that simple. If I receive $100 a year for the rest of the time, my returns are insane. But here's why I love value. It's logical. It forces you to ask, what am I paying and what am I getting? You know what made me a better investor, guys? When I started buying real estate. Because when I bought real estate, I was buying a future stream of cash flows. But when I was buying stocks 25 years ago, I thought I was just buying a ticker going up and down. And then I realized, well, wait a second. If I buy a piece of real estate that makes $100,000 this year, and next year I can make it 120, in all likelihood, my value went up 20%. How's it any different than a stock? If a company I buy that makes $1 billion a year, next year they make $2 billion, well, it probably went up in value by double. The price could have gone anywhere, and that was later on in my life that I realized that. But when I see over a 10-year period, if I bought a company and the price went up double, the value probably went up double. Let me show you a prime example about this. Guys, this is Cisco. This was the NVIDIA of 2000. This is the company, if you didn't have in your portfolio, you were stupid. Look at this chart. All-time high right here, 82 bucks in 2000. Has not seen it since then. But let me show you something very interesting. Take out this crap. How does the stock look? Pretty awesome. And you want to hear something crazy, guys? Right here, the company made about 60 to 70 cents per share. Okay? Now, it makes about $7 per share. And guess where the stock has gone? From here to here is about 10x. Profit is up 10x. Price is up 10x. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And guess what? If I were a value investor back here, I would have been criticized. You don't get it. You don't get it. You don't get it. No, you don't get it. Okay, now it makes sense. Oh, and by the way, I'd be buying right here. People were saying, you don't get it. Cisco's dead now. It's a shit company. Okay. All I saw was 10x from here to there in terms of profit and in terms of price. It's not a coincidence. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, the problem is, this is scary and this is boring. But guess what? Most people don't want boring. They want the excitement. They want the dopamine. That's why they lose. They're excited by this, not realizing it means this. I'm not going to chase the hype. I wait for the market to throw a great business in the bargain bin, and then I buy it. Hype fades, value pays. That's how wealth is built. Slowly, logically, patiently, with discipline. So, what does this look like in real life? Well, here are the companies on the screen that I put my own money into. I've got 28 or 30. But here's the key, guys. Don't copy me. Don't buy anything that I own just because I own it. I'm here to teach a process. In fact, don't buy Warren Buffett just because he owns it, unless you're going to follow him and his process. The point of this is to sit there and say, listen, I'm willing to put my picks out there and say, here's what I believe in and why. And guess what? There's a lot of reasons why my stocks could work or not work. But on a portfolio of companies that I buy for the right reasons, I will be right on a few of them. I'll be wrong on a few of them, and I'll probably be really, really right on a few of them. That's the goal here. I want you to learn how to think like a value investor. If you do that, you're going to be able to find great deals for yourself with that confidence, logic, and discipline. So for me, where do I see opportunity today? Well, let me walk you through a few stocks that I think are undervalued right now. Businesses that the market's ignoring, but the numbers tell a different story. Southwest, Adobe, PayPal. Now, these are one of several I think are undervalued. But I think something like Southwest has the biggest potential, and Southwest isn't some complicated play. But the reason I talk about Southwest is it has the highest potential, I think, of all the stocks I own. But it's in a tough industry. So which one's going to win out? Is Southwest's history of amazing profitability going to win? Or is the airline industry of incredibly difficult management going to win? The company did 1.4% in profit margin last year, 0.4% a year of the last 5 years. But historically, they did 10 to 15%. This is what I'm banking on them getting back to. If that happens and my assumptions work out, I could end up making 15 or 20% returns on my money. But guess what? It wouldn't be selling so cheap if there weren't issues with it. A company like PayPal, a company that was selling for over $300 per share, and people think is a has-been, and it's been going up and down. It recently got as high as $94 a share, and now it's back to 68 bucks. Now, I was buying it all the way to the low 50s, starting at 75 or 80. So I'm very happy with my position. But remember, I don't care about where it is today. I care about where it's going. And it's still increasing its profitability. It's still increasing its revenue. It's making more money per user, and it still has Venmo, which is growing like crazy. So I look at this and think to myself, okay, this might be a mispricing from the fact that everyone loved it here, everyone hates it here. All right, this could work out. Third one, Adobe. Now, Adobe is exciting because this is an incredibly awesome business. But of course, people are now saying, oh, Adobe's going to get eliminated by AI. Maybe, doubtful, but maybe. I look at these companies and go, I think Adobe's going to be enhanced by artificial intelligence, not eliminated by it. And this company is currently at $3.50 a share. Guys, earlier, just a year ago, just 1 year ago exactly, it was $587 a share. Now, If you're the kind of person who sees that and sees it at 350 now and says, oh, it's a dud, you're not thinking of stocks the right way. You got to look at it and say, wait, the stock is down 40%. But what about its revenue? Well, let's go take a look. Let's look at the quarters, everything by quarter. This is what's interesting about this company and what I want everybody to remember. Last year, when it was selling for $3.50 a share, it did $5.4 billion in revenue in that quarter, and it did profit of $1.68 billion. This last quarter, not the current quarter, was $5.87 billion in revenue. It's up about 10% with $1.9 billion, about even in its profitability. The revenue's up, profit's even, stock is down 40%. Now, it doesn't mean that when it was selling for $5 whatever, that it was worth $5 whatever. It just means that pay attention because the stock is down, but the revenue is up and the profit is even. That's kind of interesting. That's the way I want to look at things. But more importantly, I want to look at things from a long-term perspective. I don't think to myself, what's this company going to do in the next year or two? I really live by the adage in 1996 annual report that Warren Buffett says that your goal as an investor should be buy a business that you understand, that you can with almost certainty say that in the next 5, 10, 20 years, they're going to make substantially more money. Everybody's circle of competence, their ability to understand it is limited in certain areas. With software, I look at it going, I've seen people use Adobe and I see all the amazing things they do with it. What are the chances it goes away? It could, but again, are they going to bring AI into it to make it better, or are they going to be the victim of AI? I don't know. I'm willing to bank that they're probably not going to go away. And I look at that and say, okay, so let's look at the next 10 years. What's the future revenue of this company doing? Well, I put in 4, 7, and 10% revenue growth. I started with a low number, went to a high, and probably somewhere in the middle. Profitability. I did 26, 29, and 32, but most importantly for Adobe, their free cash flow is much higher than their net income. That's a huge benefit because most people only focus on net income. We focus on cash flow, and it's significantly higher, so a lot of people are missing the value there. Now, 10 years from now, what's the PE going to be? Guys, I put 18, 21, and 24. The market average is 15, but this is a growing business with a growing return on capital. What that means is, as time goes on, they get a higher and higher return on the money that they invest into their business. That's a company you need to pay a premium for. So if the market average on PE is 15, I got to go higher with Adobe. And they also have a 80%, 90% gross margin, which means every dollar they add in revenue, a big chunk of that goes to the bottom line. That deserves a premium. So even if they only grow their revenue 4 or 5% a year, they can still grow their profit 7 to 10% a year, which is huge. Now, what's my desired return? Now, guys, I just use this to find what's the market return, 9%, 10%, but this has no margin of safety. I need to have some margin of safety in there because I'm buying an individual stock. We're humans, we make mistakes, and the future's unknown. Who'd have thought 10 years ago that Elon Musk would go from one of the most revered guys in the country to one of the most hated? 10 years ago, that was blasphemy. Oh, you're just a hater. It's like, not even 10 years ago, 6 years ago, that was blasphemy. This guy's changing the world. Yep, but all the Tesla bulls out there said that by now, Tesla should be selling 5 or 10 million cars a year. They're going to struggle to do 1.8 million cars this year. We don't know the future. You've got to be conservative. So I hit the analyze button. And guys, here's what I have. I have Adobe worth 368 on the low side, 790 on the high side, 540 in the middle. So based on this and today's price, if I'm right on the middle assumptions, that's a 15% return. Is that for sure? No. But if I buy a basket of companies, 30 companies with the same kind of ideas here, with this kind of return, I'm going to do pretty well. Am I going to make 15%? I don't know, maybe. But I know that if I'm wrong, I'm still going to make 10, 11, 12%. Now, guys, during the bull market of the late 90s, I just thought you just buy a good story and you watch it go up. Now, I didn't fall for all the hype out there, but I fell for enough of it where it hurt. And after the crash happened, I was like, okay, there's got to be a better way. There's no way that a guy like Warren Buffett, all these great value investors, have beaten the market over long periods of time. And they warned us about the late 90s, and they end up being right. I used to think like, oh, beating the market's for those people. It's like, no. As time went on, I realized it's for everyone. Everyone has the mental ability, as Peter Lynch says, and the knowledge to be able to beat the market. Who has the stomach to be able to? Who has the ability emotionally to sit there and say, when the stock is falling, that you believe something the market doesn't believe? This is where my change happened over the years. Now, the benefit you have is you have YouTube. You have people to watch. It's also a detriment because there's a lot of people out there not teaching a process. They're riding a wave of a stock going up. There's an idiot out there who literally thinks that Palantir at 190 a share is a good buy, even though it's selling for hundreds of times sales, 100 times sales, selling for 600 or 700 times profit. Guys, they might be right. Palantir is an incredible business. But the fifth and most important tenet of principle-driven investing is a great story can become a bad investment if you pay the wrong price. If you don't understand that, just stick to ETFs. But it's really, really important, even if you buy ETFs, to make sure you understand that concept. If you don't believe there's a way to overpay, then you're probably gonna have a hard time making money in investing. Now, a very common question is, when is the right time to buy stocks? My answer is simple. Anytime that you can buy a great business at a discount, that's when you do it. Yes, the market's overvalued. Every metric that's reliable has said that. But guess what? Value investors over time say, listen, you can't time where the market's going to go. And they're right. And this is something that I only learned in the last few years. I try to fight that. But at the end of the day, if you buy a great company at a great price and the price goes lower, you got an even better deal. And guys, trust me, it's exciting to see a stock go up. I bought Sprouts Farmers Market in the low 30s, and I lost it to covered calls at 165. And guess what? I loved watching it go up. But when it got to 160, 165, I was like, this thing ain't worth 160 to 165. But I'd learned my lessons in years past with Facebook and Microsoft that you don't sell a great company just because it's up a lot. But let me be clear. I believe with every ounce of my being that buying great businesses at great prices will always beat chasing hype in the long run. Why? Because hype is temporary. Cash flows, profits, and discipline, those last forever. When people say value investing is done, my comment is, so it's done that people want to get more than what they're paying for? That's never going to go away. When you go to a store, you want to get more than you're paying for. If not, I encourage you to tell me the last time you went into a store, refused to pay their price, and you said, I want to pay you more than you're asking. That's ridiculous. Wealth is built by owning real businesses that make real money and paying a price that makes sense. A rational price, as Warren Buffett and Charlie Munger say. And here's the best part. It doesn't matter if you're 20 or 60, bull market or bear market. If you consistently pay less than what you're buying, you are heavily stacking the odds in your favor. It's not flashy. It's not adrenaline, but it works. And that's why I love it. Buy great businesses, pay a great price, and you will build immense wealth no matter when you start. So guys, you've heard me mention these principle-driven investing ideas, and there are 5 tenets I live by. We are investors, not speculators. Every investment is the present value of all future cash flow. If we don't understand it, we don't invest in it. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the fifth and most important one is a great story can become a bad investment if you pay the wrong price. Guys, I'm going to explain these in further detail. If you want our absolutely free PDF with a full explanation, click the link below. It'll be emailed to you within 1 minute, absolutely free. Guys, so to recap, if I had to start all over tomorrow with nothing, I wouldn't even touch hyper speculation. I would dollar cost average in low ETFs, but I'd lean in 100% on principle-driven investing because it works. I would do it for the ETFs. I would do it for stocks. I would focus on buying great businesses at great prices. I would trust that process and let time do its job. It's choosing logic over emotion, math over hype, patience over panic. In the short run, market's going to rise, they're going to fall. Headlines are going to come and go, but principles won't change. That's how you win, whether you're starting from scratch or you're building on decades of compounding. This process works in bull markets, bear markets, and everything in between. These principles keep you grounded. They keep you rational. Now, guys, just to prove this, I'm taking on the most hyped stocks in the last 20 years, the Magnificent Seven. I've made my own personal Magnificent Seven. So if you want to see me use the stocks that I own to go against the best, I made this video. I picked 7 stocks back in January to go head-to-head with the Magnificent Seven. Click the video because the results are going to surprise you. Thank you for your time.